So, Felicia, take it away. Thank you for joining us.
Got it. Thank you. So, Nancy, thank you so much for including me as part of this program. I am looking forward to it. So I am really bad at watching the chat. So she's gonna take it over. But I want to just ask you, I have a 2-year-old. When my daughter was 2, she was a I do it myself girl. Has anybody got any kids in their lives that are I do it myself? That was my daughter. And so what I'm going to be talking about today is 3 ways to build your wealth, and one of which you're probably not even using. So the reason I recognize that in my daughter is because I'm a do-it-yourself girl. I always like to do it myself, especially when we're talking about anything related to money and finance. So what I'm going to do is I'm going to take really about 15 minutes to just kind of talk to you about 3 places to build your wealth. As I said, one of which you're probably not even thinking about. So who I am is I'm a financial advisor. I've been a financial advisor for over 30 years. And the reason this topic is really, really important, and it's the great first day to do this, is because today is tax day. Everybody's got their attention on, did I pay too much in taxes? Did I not pay enough in taxes? How will I be able to save on taxes? And so today's topic is going to be very tax focused. The problem for many of us as entrepreneurs, and I'm an entrepreneur talking to entrepreneurs, is the fact that, sometimes we don't know what to do. And so for do-it-yourself people like myself, what we do is we go to the internet, we talk to our friends, we do all that sort of things. And that may or may not give you the solutions that you're looking for. So when I talk to people, one of the things that they say is important to them, the reason they don't gather or have a lot in retirement is they don't know what to do. So I'm in the time that we have today, I'm probably not going to give you the answers to what you need to do, but I'll give you some starting places and some things for you to think about. And I find that a lot of people are unknowingly and unnecessarily paying more than their fair of taxes. Is anybody like me who feel like they are paying too much in taxes? Yeah, there's a couple of hands up there. Yeah, so a lot of us feel like we're paying too much in taxes. So we'll talk about how you can use your business to shelter some of your wealth so that you're not paying too much in taxes. The other thing that I have found, and when we think about taxes, is people don't have the optimal amounts of money in the 3 buckets. And I'm going to describe the 3 buckets for you. But there is a mathematically determined amount that you should have in the 3 buckets, and I'm going to talk to you about that. So as I said, I'm a do-it-yourself girl. So when I first got started in personal finance, I started with $5 a month savings. And I'm telling you, my friends were like, why bother? They were just like, Felicia, there is no reason for you to be saving $5 a month. And it was back in my 20s. I have to tell you, sometimes that money went into my car to pay for gas. And sometimes that went to buy, 20 packages of top ramen. But I was really trying to get into the habit of saving money on a consistent basis. And then I also ended up changing careers. I was working for the estate planning department of a law firm, working with a lot of people who were very wealthy. And I was seeing that what they were doing was very different from what I was doing. And I decided that I maybe needed to do something a little bit different. So, as I said, what we're going to talk about is we're going to talk about taxes. And taxes is not just about, about paying taxes, but you also need to think about not just today's taxes, but you also need to think about future taxes. And oftentimes when I'm talking to entrepreneurs, many of us are kind of in the mode where we don't have time to think about future taxes. We're trying to figure out how we're going to get paid today so that we can take care of what we need to. But I want to invite you to think about taxes and start thinking about your future in a different way. So taxes is really the cost. If you pay too much in taxes, you end up paying more for federal taxes. If you're not handling your taxes correct, you could end up paying more for your Social Security benefits when you get them, if you believe that you will get them. It can increase if you're not handling your taxes right. You could end up paying more in Medicare premiums, and it will definitely devour a portion of your income, of your legacy building. The more you pay in taxes, that's money that's not in your pocket. That's money that you cannot move on to the next generation. So there's really two paradigms. The old paradigm, which is kind of the paradigm that I was in, and oftentimes when I talk to people before we start working together, they believe that taxes are going to be lower in retirement. Does anybody out there think that taxes are going to be lower for them in retirement? So Nancy's shaking her head no, but for many of the people that I talk to, they do think, there was the old paradigm that when you retire, your income is going to be lower, so your taxes are going to be lower. And they also believe that they're going to be living on less income at retirement. People like myself say that you need to be bringing in about 80% of what you're making today in retirement or more in order to live the comfortable lifestyle that you want to live. And they also are putting most of their dollars into tax deferred vehicles, which again is the old paradigm. The new paradigm I want to introduce you to is instead thinking about things you may very well be in a higher tax bracket in retirement than you are today. And you may need as much income in your retirement as you do today during your working career, which is again a different paradigm from the one that many of us were brought up in. And it's important that you thoughtfully and proactively put money aside into retirement accounts so that you have the resources that you need in retirement to extend your life. So many of the people that I talk to who are looking at retirement they want to travel, they want to leave a legacy, they want to they want to participate in charities. I hear Barb is out there playing, she's playing pickleball in hers. I've got some clients who are also playing pickleball in their retirement, and they do not want to stop playing pickleball to go back to work. So that is definitely one of the things that is true in the new paradigm. And the reality is, as you get older, some of the greatest deductions that you get while you're working go away. And so it's important that you keep those things in mind. So I just really want to kind of take you back and have you look at kind of the marginal tax breaks over time. So if you look at 1913, when they first implemented taxes, now when they first implemented them, they said that, hey, we're only going to do it for a couple of years and then we're going to stop. But here's the reality with Congress and our government is once they're getting money out of your pocket, they're not going to give it up. But you can see that taxes have been as high as 94%. That was during kind of World War II, World War I, they were up, and they've been up, could you imagine, Nancy, I'm sorry, I see your hand. Go ahead,
I don't
Nancy.
understand this. Are you telling me 94% of your income went to taxes in
Yeah,
1930? What? Okay, that's what I
yes.
thought this said. That's why I was like, explain this to me.
Yes, that's exactly it. And this is kind of like around the Ronald Reagan era. And so one of the things with Ronald Reagan, if you're from California, as me and Nancy are, one of the things that we know is Ronald Reagan used to be the governor. And one of the things that was also true is he only made two movies a year. And the reason he didn't make a third movie is because at his pay level, he would have to give like 50% of his money to the government before he would have to give 50%. The next movie, he would have to give 50% of his money to the government. He wasn't willing to do that. So again, you can see that for people I often ask them, do you feel like you're paying too much in taxes? They often will say yes. And the reality is, but if you look at kind of the marginal tax rates over the last decade, you can see that we are at some of the lowest rates that we've ever had. And so one of the things that is true is the government has a lot of things that they have promised us that they haven't really paid for. And so there's a good chance that they may have to do something about this. This is David Walker, who was the controller under Bush, and he says, regardless of what politicians tell you, any additional accumulations of debt, like national debt, are absent dramatic reductions in the size and role of government, basically means deferred tax increases. So unless we can get our fiscal house in order, there's simply no way we can handle our ever mounting debt burdens without doubling taxes. So what do we know about the past? It tends to repeat itself if we don't make adjustments. So this is just looking at 2023 taxes, and so this is basically saying that if we're going to pay for the debt that we currently have, we may have to go up to 88%. And you can see that between 1960 and 1963, tax rates were up as much as 87%. So the rates that we are currently paying are a lot lower than they've been in the past, and we may need to do something about that. So there's, as I said, there's three buckets, and this is one of the things that Nancy got really excited about when I was talking to her. I was like, there's three places that you can put your money. The first one is the taxable bucket. The next one is in the tax deferred bucket. And then the last one is in the tax-free bucket. And in order to protect yourself from rising taxes, as I believe will have to happen for the government to address all the unfunded liabilities that they have, you need to have a mathematically ideal amount in each bucket. So I'm going to just talk about the various different buckets. And the first bucket I want to talk about is the taxable bucket. And the taxable bucket is really an account where you pay taxes on the interest, dividends, and capital gains in the year that you earn them. So one of the things that Nancy asked me about is, well, is that where you would have your emergency funds? It is exactly where you would have your emergency funds, because every year that you would pay money on the growth in these accounts. So the money that you have in your savings account, your checking account, any of those things, you're paying taxes on those on that amount every single year. So as I said, it's your savings account, it's your money market fund, it's your CD. And the good thing about those things is they're generally pretty liquid. So you can get to them easily, you can take out of them, you can do all the things that you need. This is not what where you want to have your retirement dollars. This is the money that we always talk about in having it readily accessible for your emergency funds. So we usually, in my industry, we often will talk about having 3 to 6 months. Often when I'm talking to business owners like yourself, I'm often suggesting that it might need to be higher because of the ups and downs that we have getting the next customer. So oftentimes when I'm talking to business owners like yourselves, I might suggest that you have more than the 3 to 6 months, just because because you've been running your business for as long as you've run your business, that things are seasonal. Clients are seasonal. The decisions that they make can be seasonal. We were just talking with, I think it was Robert who was talking. Was it Robert that did the lights in San Diego? Was that you, Robert, or was that somebody else?
Not me, no.
So it wasn't you, but there was
It's
somebody
Sal.
here who was. Pardon me?
That
Sal.
was me. That was me.
Sal. I apologize, Sal.
No
So
worries.
Sal has done the lights in San Diego before, but he's not sure if he's going to do the lights in San Diego this year. And so that could have an impact on your finances if you were counting on getting the San Jose light show thing. So, one of the things that I'm often getting asked nowadays is, well, what about high yield savings accounts? High yield savings account fit into this bucket that I was just talking about, but the risk is having too much money in this particular budget, this particular thing. And when interest rates have been high, I've been having a harder and harder time getting people to take money out of the call it 6 months to 9 months of living expenses, just because they know they can get 4 or 5% interest on just on their accounts. But the problem with that is it's inefficient. And what that means is, in terms of tax efficiency, is you're paying taxes every single year. And you are also dealing with the fact that we've got high inflation. So if inflation is 3% and you're making 6% or 5%, then you're keeping 2%. But if inflation is 6%, as it is now, and you're putting 6% in, then you're really not making any money, and you're kind of treading water as you kind of go forward. So it's important that you understand how that works, because inflation really is a thing. So there is a risk of having too much in your savings account, and it's something that you should definitely think about. So that is the taxable bucket. Any questions about the taxable bucket?
Yeah, I had a just question when you said that about the high interest savings account. Well, if you don't have it in that account, like I'm just in my normal banking, right? My normal savings account, which is what, maybe 1%, if that. Then I feel like I'm losing money with inflation. Wouldn't you be better off making at least that 5%? Because I haven't
Yeah,
done
it
it.
would be. So oftentimes what I might suggest for somebody like you, Nancy, is I might suggest that you keep 1 month, 2 months, 3 months in your checking account and just get whatever it is. But if you have more dollars than that in savings, I might shift that to the high yield savings, so that you're having more of your money getting the higher rates of interest than just the 1% that your
Got it.
bank
Okay.
is doing.
Thank you.
Yeah. Is that clear?
Clear. Anybody else? Carry on.
All right, great. So the next bucket that I want to talk about is the tax deferred bucket. And this is money that you don't have to pay taxes on as the money is growing. So oftentimes, if you, depending upon the vehicle that you're using, the contributions can be tax deductible, which can be very helpful. And why you need it is you just always are going to need retirement dollars. You're going to need retirement dollars. You're going to need retirement dollars. I can only say that so many times, but you really need to have it. But realize that with the various different things that fit into this bucket, they don't all have the same rules. And it's important that you understand how Roths work. I'm going to talk about Roths and SEPs today, because those are oftentimes and can be a good starting point. And then the other thing I'm also going to talk about is I'm going to also talk about 401ks. The thing that's important that you understand is you can use any of them. So I was talking to a reporter this weekend, and she was asking me which one of these is best. And I was just like, what is best is whatever you can do. I was just like, there is no best. So I was saying to her that for somebody who doesn't want to set up a structure, then using a traditional IRA or a Roth IRA can be a great way. The traditional IRA, depending upon your income, could be tax deductible. Roth IRAs are not, but still they have very similar requirements. You can put in $7,000 if you were under 50, $8,000 if you're over 50 for traditional, and that can be a good way to start. The other thing to realize about these in the tax deferred bucket is they can look like all sorts of different things. 401ks, as I've talked about, TSP if you work for the federal government, can be there. There's IRAs, there's 403Bs if you work for as a school teacher, 457 plans if you work for city governments. Oftentimes, simples can be another type of retirement plan. So there's lots of different vehicles. So when I talk to business owners like yourselves, they often are just like, well, which one is right? I don't know which one is right for you. It really can depend on all sorts of things like what is important to you, what kind of structure do you have for your business, how much can you afford to put into them. So these are all of the things. So I said I was going to focus on SEPs. So let me talk about SEPs. The SEPs are often one of the easiest things for small business owners to put in. They're very flexible. You have complete discretion over them. They're easy to set up. They're easy to administer. They often have a lower cost than some of the other ones. They can be the contributions to put into your SEP are tax deductible to as an employer, and over the next, you may be eligible for a tax break of anywhere between $500 to $5,000 over the next 3 years if you set up a SEP. Now, the disadvantages of a SEP is the fact that there is no catch-up provision. So sometimes you talk to people who work for, I'm going to call it traditional businesses that have a 401k. They talk about catch-up contributions. That is not available with the SEP. The only contribution that goes into it is the employer contributions. The employees, if you had any employees, would not be contributing to it themselves. And so that can be a disadvantage. With the SEP, you can put 25% of your income up to $70,000, whichever is less. So SEPs are a good choice. Now, for other people who have a different business structure, you could do the 401k. So one of the things that Barbara said to me when we were preparing for this is she said, you know what, I had a SEP for years and I didn't even know that I could have a 401k. They actually now have solo 401ks, which are very similar to the plans that you have with larger employees. And so you could have your own 401k for your business, which is a tremendous benefit. If you are under 50, you can put in 23,500 this year. If you are over 50, you can put an additional 7,500 or $31,000 into it. Or if you are in the sweet spot of 60 to 63, you can put in an additional $11,250, which brings you up to $34,500. So it can be, it's very similar to the plans. Now, depending upon how you set it up, you can have lots of options. I've seen people use their 401ks, a self-directed 401ks to buy property and whatever. So it really depends on who you set that up with. But it's got a lot of flexibility inside the plans, and it can be a really great start for employers. The other things that
I have a question about that though. Can
yes,
I
go
ask
ahead.
a question about the 401k? So you just said a SEP, we can put 25% or 70,000, but a
Yes.
401k, I never saw the number go up higher than like 23,000 or what have you. Why is a 401, what's the difference? Why is one better than the other? Or are there? That's not, they're apples and oranges.
So you can actually put in more in, they call it a cash balance of 401k. So basically, so you can match your 401k with a profit sharing plan and be able to put a lot more into it. But I was just giving you the basics of it. So again, the thing about retirement plans and whoever you're working with is they can talk to you about what you're trying to do with your retirement plan and design a retirement plan that works for you. So if you have employees, if you don't have employees, if you have your spouse working in your business, you can put in retirement dollars. They can put in retirement dollars, and it could be a nice pot of money for the two of you. So again, it depends on how you structure it. But you're right. It can be more than that $24,000, but it has to be structured and set up correctly to reflect that.
Yeah, because our CPA was, because I'm an S corp, was very when I finally learned I could have a 401k, and this year it's kind of a hassle to set it up and it's hassle to maintain. There's all these rules. And I was like, can I just put it in IRA or SEP this year? Like I was over it. She's like, no, we're going to 401, you need to put it in your 401k. And I don't remember why, but she was very adamant that my husband and I, we own the business together, like we put, and then our company could match it. And I don't know, like, Tempo, I'm an employee, he's an employee. We put our 401k money in and then Tempo can match it. And I don't know the tax benefits for doing that, but that's one of the things they were saying. So it's still very confusing to me, but I thank you for letting us know that it is an option and to speak to your financial advisor about why. And I don't really understand why she was like, nope, we're going to put it in the 401k. I just hate my 401k plan people. Don't go with paychecks. I'm going to just say that right now. That's
Yeah,
why I'm just mad at
different,
paychecks.
yeah, different companies have different rules, and some of them are more flexible than others. And so if you choose the wrong one, it can make your life very frustrating. Let's just put it that way.
Yes. And there's a company called JustWorks who's great and they can set up a 401k for you and they're lovely. Just don't do paychecks.
Got it.
Yes, Daniel.
Yeah.
How would you advise making the appropriate selection?
Of plans.
Yeah. I mean, is there anything that's either within like location or insurance related? I don't really know how that works, to be honest.
So I'm going to be careful how I answer that question. So what I would say to you is, and it's the same advice that I give for picking up the right financial planner. You just got to find somebody that you fit with, who speaks to you in a language that you understand, because my industry can speak in jargon. You know how I was just like, well, what is a shot collar? There's a lot of that in my industry as well. So you need to talk to somebody who understands, who understands your business, who understands how what you're trying to do with your business, how flexible your income is in structuring it. So all of those things go into determining what's the right plan for you, Danielle, as opposed to whatever. And you're right, some companies are with mutual fund, some companies are with mutual fund companies, some of them with insurance companies, some of them are with payroll companies. So there's lots of different places that you can get them. So that can be a little bit challenging to deal with. But if you don't have paychecks and you are doing payroll, you might want to take a look at somebody other than paychecks. There's a company called Solo 401k that I work with, that that's all they do, is they only work with solo entrepreneurs who are looking to do a 401k, and those guys are lovely to work with. But there's lots of different places to go to find that. So I'm sorry, there is no right answer for you, Danielle, but there's lots of places that you can look in. And sometimes it's just a matter of talking to a bunch of people, talking to other people, who are you using? And you will hear people who love theirs, and then you'll hear people who hate theirs, and you stay away from those.
And Felicia, what's your role? Like, is that part of what you do, is advise people on where to go and who to like, or do you do it too? Like, what's your role? How can
Yes,
we
that is
support you?
something that I can do too. So,
Awesome.
yeah, so depending upon the structure of your business, oftentimes I might work with your accountant to come up with what's the right plan for you. So again, it depends on how you've got your business structured, who's on your team, to see who would be involved in that conversation.
Perfect. Thank you. Okay.
Mhm.
Back to our scheduled PowerPoint presentation.
Scheduled presentation. So the good news about 401ks and all of these various different things, that you can get a tax deduction. When you take money out, they're subject to ordinary taxes. So again, if your current tax rate is 20% and or 22%, and you expect that it will be higher in retirement, then you definitely want to pay attention to that, because like 401ks have now got a Roth option on them. And so you can actually put some of your dollars in the Roth bucket, as opposed to just do the pre-tax dollars. And again, that only makes sense if you are that only makes sense if you believe that taxes are going up.
And that's what my financial advisor had me do when I could do Roth. He's like, dump in your Roth. It doesn't benefit you today. It kind of hurts today because you're taxed on that income today. He goes, but I have a hunch our tax, that's why I raised my hand, that the tax rates are going to be higher when we retire. There's no doubt about it. You just showed us that graph. So he was explaining to me to dump as much as I could in a Roth and pay the taxes today at a lower tax rate, because when we retire, odds are, right? That's the benefit of the Roth.
That is. So with 401ks, and this is specifically for people who have 401ks through employers, generally, oftentimes we will tell you to only put in up to the match and not a penny beyond that. And we have different reasons for doing that. But that's something, because we always believe that you should get all the free money that you can. If they're giving you free money for the match, then go ahead and do that. And I'm just saying that for many of you who are perhaps in your businesses by yourself, that you might be married to somebody who is got a 401k. This is the advice that I gave my husband. Just do the Roth, sweetie. That's all you got to do, is listen to me and just do the Roth. That's,
Had a girl.
that's all we had to do. But and given the right tax, the but given your current tax bracket, it still might make sense to go with the tax deferred. So I'm not saying to only do the Roth. It really can depend upon your financial situation to figure out which one was going to be best for you. So the last one that I want to talk about is the tax advantage. This is the Roth option for many of us. And this is money that is exempt from taxation, federal taxation, state taxation, or capital gains. Why do you need it? I believe that you need it because I believe that tax rates are going up, and and it'd be great to still be getting the money that you need in retirement, but only paying taxes on the portion that went into a tax deferred account. So the challenge is that people don't always understand how to use a Roth, or don't know how to find a Roth. It's really simple. You can get one with really any custodian out there. Just realize that you're not going to get the tax deduction. You're focused on really just building your money. And the other thing is about Roths in particular is there are some income limitations. So if you make under $125,000. No, I'm sorry. If you make under $150,000, you can fund a Roth. If you're married filing jointly, it's under $236,000. If you're under, and then for the next $10,000 above that, there's a phase out. So you just need to make sure that you can qualify to put money into a Roth. It makes sense for you, and then you can kind of go ahead. So some of the things that some people often will think about as tax advantage include municipal bonds and oil and gas. And we don't believe that those are, because they are only free from tax from two of the taxes, not all three. And the distributions from those can increase your Social Security. So we believe that something is tax advantage if there's no federal tax, no state tax, no capital gains, and distributions aren't going to cause your Social Security to be subject to taxation. So Roth 401ks, IRAs, Roth conversions and properly structured life insurance. These are all the types of vehicles that are tax advantage. Oops. So I covered a lot in the time that I spoke. The thing that I really want to leave you with is a lot of the people that I work with are not focused on minimizing their taxes. I think it's an important thing that a lot of people are missing. And so they are going to ultimately pay more to Uncle Sam than they need. And that leaves them with fewer fewer dollars to pass on to the next generation. I've made the assumption in this presentation that taxes are going to go up in the future. And then I talked about 3 places to hold your money. And there is a mathematically optimal amount to have in each of the 3 buckets that I talked about. And I didn't really talk about how to do that. But if you're wondering if you have the optimal amount, then I invite you to reach out to me. So really what I want to leave you with is, for the people that are, the reason this is an important thing is because I'm assuming that you're one of those people who wants to retire with complete peace of mind. You want to travel the world with your friends and family, and you want to have your money be in alignment with your life's purpose and the dreams for the future. And you're also looking to leave a legacy to the next generation. So I talked a lot about a lot of things, but the reality is, in the things that I talked about, there was a lot of stuff that I didn't have time to talk about. And so the question is, how can I help? Well, I really have a gift for everybody. So if you're somebody who is interested in getting further education, we have a course called the Financial Foundations course, which starts next week. So it doesn't give you a whole lot of time to think about it, but it's an 8-week course that me and my organization put on. It covers all of these various different topics, and it's completely for free. But it's really for people who want to get educated about these various different areas. It's not an opportunity for us to sell you anything. It's really so that you can get educated. So we created this course for Gold Star families. Is anybody on here familiar with what a Gold Star family is?
Yeah.
Okay.
The military, right?
It is a military. It's not, but it's not just a military, but it's a military whose spouse has died as a result of being in the military. And so we originally created this course for Gold Star families. What we were finding is, we were working with Gary Sinise, who was Lieutenant down from Forrest Gump. And what he was finding, because he works with a lot with military families, is you have these oftentimes spouses left over with children, and they've gotten like $250,000 to $500,000 as a result of their spouse dying. And they were being sold into annuities, which is really great for the person who is selling it, but not so good for a 23-year-old, 25-year-old to have money that they have no access to until they're 25, until they're 59 and a half, without paying a penalty. So we created this course to educate them about how to handle their money and make some of the decisions that they're being asked to make. And so if you're interested in this, you can go to financialfoundationscourse.com, and there is a link there about halfway down the page, and you can register for it. And the way that I talk about this class, it's fantastic. We've gotten some really great reviews over the 3 or 4 years that we've been offering it. And we've had probably 1,000 people walk through the course over that time period. And we think it's a service that we offer to everybody. So if it's something that you think that you would be interested in, then I invite you to register for that class at financialfoundationscourse.com. Tell them that you were interested in taking it with me, and I will walk you through that.
That's awesome.
That's
Thank
awesome.
you.
Or if you were interested in perhaps just having a conversation with me directly, you can go to my site, which is financialcontrolmastery.com. There's a blue button up in the right corner, or a purple button up in the right corner. You can just sign up to sit down with me, and I can just go over your particular circumstances. So either one of them is a great option. And I think I took more than my 15 minutes, but
Oh,
I
good.
hope this was really good information for you.
I think it was awesome. Thank you. The one thing that I learned as a freelancer a while ago that I told you we would touch on, I was like, I'm gonna bring it up, Felicia. Y'all, is the HSA, the health savings account. It's one of the best tax advantage accounts, right? And I didn't realize, like, you put you have to have a high deductible insurance plan, which we have. I mean, my husband, I have to go get my own insurance as a freelancer too. We don't have a 401k or, we're not another company doing this for us. So I always have my own insurance. And so I get this high deductible plan. And then you can contribute, I don't know how many thousands of dollars it is this year. Say it's $8,000 a year. You put into your, I take it monthly out of my savings account or my paycheck. Actually, my savings account because my company doesn't, whatever. So I say I put $8,000 a year in. Now you can use that money to reimburse yourself for medical expenses. And I was doing that until I had a financial advisor friend go, don't touch that money. Let it ride. Let it ride till you retire because you could pull it out tax free. It's good. It's in a mutual fund and just growing and growing and growing and growing. I just keep dumping money into it when I can, and it keeps growing. And then you can use it for medical expenses, but can you also use it for just general retirement after a certain age, or just medical still, which you will probably have medical expenses?
So it's
what's
just medical expenses, but here's the thing that's really great about it. What I do and other financial advisors that I know is we just hold all of our receipts for, decades.
They're in a
And
fireproof
then-
safe.
and every receipt that we have for medical, and then we'll submit that in retirement. And so that allows us to basically use tax-free dollars that have grown over the last 20 something years. And I'm not paying any taxes on it. So it's tax deductible, it grows tax deferred. And as you're taking money out, it's all tax-free dollars. So it's the triple threat. And if you have a high deductible plan, or if you want to consider putting in a high deductible plan, it can be a really great thing. So
Yeah.
sometimes I talk to people who have a high deductible plan, and I'm just like, well, where's your health savings account? They said I didn't understand it, so they didn't have it. So those things go together. So if you
Wow.
have the high
Yeah.
deductible plan, you should have health high and HSA, health
And
savings
either
account.
fireproof safe or electronic copies of all of your medical receipts. I have a fireproof safe, and now I'm doing them all digitally. And I literally have a file. Every time I get a bill from the doctor, it goes in this HSA folder so that when I need it, I have thousands of dollars tax-free ready for me when I need it. I've just been doing it for, I don't know, like 10 years now. Just save all my receipts, and now I'm making them all electronic. So love that for freelancers.
Yes, it's a great thing for freelancers. So
Yeah.
put in a retirement plan, work with the financial advisor if you need to, get an HSA if you have a high deductible plan, and just remember that there is 3 buckets and there is an optimal amount of money to have in each of them. And you will learn more about that if you chose to go into the Financial Foundations course with us that starts next week.
Or
And
you
we
give
offer it 3
Felicia
times
a
a year.
check.
So if the timing doesn't work for you to do it next week, we'll offer it again in the fall.
You are awesome. Very good. That was really good.